Imagine you wake up one morning and your bank account shows exactly what it always does. Your salary landed, your bills are paid, everything looks normal. But somewhere in Jakarta, a factory just shut down. In Nairobi, a government is quietly rationing fuel. In Buenos Aires, a central bank governor is staring at a spreadsheet at 2 a.m., doing math that doesn't add up. And the reason all of those things are connected to each other and quietly to you is a shortage of something you probably think the world has too much of: dollars. Not a shortage of money, not a shortage of value, a shortage of dollars specifically, the actual green currency, or more precisely the digital equivalent that runs underneath the global financial system like electricity runs underneath a city. When the power goes out, you notice. When the dollar supply tightens, most people don't, until they do. And by then, it's usually too late to do anything about it. This is the story of how that works, why it keeps happening, and why the next time it happens, it might be bigger than anything we've seen before. Let's start with a number. Roughly 58% of global foreign exchange reserves are held in US dollars. That means when a central bank in Malaysia or Nigeria or Chile wants to feel financially secure, to show the world it can pay its debts, import critical goods, stabilize its currency, it holds dollars. Not its own currency, not gold, not euros, dollars. And this isn't just central banks. About 40% of all international trade invoices are denominated in dollars. Even when Japan sells cars to Germany, a significant slice of that transaction runs through dollar-denominated systems. When commodities move, oil, wheat, copper, they're almost universally priced in dollars. The dollar isn't just America's currency, it's the world's operating system. And here's the quiet irony sitting at the center of all of this. The United States doesn't actually control how many dollars the world needs. It only controls how many dollars it creates. And those two numbers are almost never the same. This gap, the difference between the dollars the world needs and the dollars America supplies, is where the dollar shortage lives. To understand why this gap exists, you need to understand something called the Triffin dilemma. Robert Triffin was a Belgian-American economist who back in 1960 spotted something that nobody in Washington wanted to hear. He said, if the US dollar becomes the world's reserve currency, the United States will face an impossible contradiction. On one hand, to supply the world with enough dollars to run global trade and finance, America has to run persistent trade deficits. It has to spend more than it earns. It has to let dollars flow outward constantly. On the other hand, if America runs those deficits long enough, the world will eventually lose confidence in the dollar itself, because a country that always spends more than it earns looks, eventually, like a country that can't pay its bills. Triffin basically said the world's reserve currency will always carry the seeds of its own crisis built right into the system. Nobody solved this problem. They just kept going. And for decades, it worked. America ran deficits, dollars flowed out, the world grew, emerging markets industrialized, global trade exploded, the system hummed along. But underneath the hum, something was accumulating: debt, dependency, and the slow structural tightening of dollar availability in the places that needed it most. Here's where it gets interesting. When people hear dollar shortage, they imagine something simple: not enough paper bills, printing press not running fast enough. That's not what this is. Most dollars in the global system don't exist as physical cash. They exist as credit, as loans, as ledger entries in correspondent banking networks, as swap agreements and eurodollar deposits, as the digital shadow of transactions happening across time zones every second of every day. The eurodollar market, which has nothing to do with euros, by the way, is the offshore, largely unregulated pool of dollar-denominated credit that lives outside the United States, outside the Fed's direct control, outside American jurisdiction. It's the dollar system's shadow twin. At its peak, the eurodollar market was estimated to be in the tens of trillions of dollars. Nobody knows the exact number. That's not a journalism problem. That's the nature of the system. It's not centrally tracked because it wasn't centrally created. It grew organically through decades of international banking, interbank lending, and the simple reality that the world needed more dollars than the Fed was printing, so the banking system manufactured them through credit. And here's the critical piece. When credit contracts, when banks get nervous, when interbank lending tightens, when risk appetite collapses, those synthetic dollars vanish, not gradually, fast, sometimes almost overnight. That is a dollar shortage, not a physical shortage, a credit shortage, a disappearance of the manufactured dollar supply that the global system had quietly come to depend on. You want to know what that looks like in real life? March 2020, the pandemic hits, global markets freeze, investors panic, and in roughly 2 weeks, a scramble for actual dollars begins that shakes the entire global financial system. Countries sell U.S. Treasury bonds, considered the safest assets on earth, not because they want to, but because they need dollars now. The dollar surges, emerging market currencies collapse. Companies that borrowed in dollars but earn in local currencies suddenly face debts that have become dramatically more expensive to repay. The Federal Reserve, watching this unfold, does something remarkable. It opens dollar swap lines, essentially emergency dollar lending facilities, to 14 central banks around the world. It floods the system with dollar liquidity directly. It works. The crisis stabilizes. Equity markets recover. Everyone moves on. But nobody asks the obvious question. If the system is this fragile, if the world's financial infrastructure can seize up in 2 weeks because of a dollar supply squeeze, what are we actually running here? The answer is a system built on trust, leverage, and the assumption that the Fed will always step in every single time. And that assumption has never been seriously tested. Not really. Not yet. Now let's talk about who actually suffers when dollars get scarce. Because it's not Wall Street, at least not first. It's the developing world. Countries that export commodities, oil, coffee, copper, palm oil, get paid in dollars. They also import essential goods priced in dollars. They borrow from international markets in dollars. Their governments issue bonds in dollars to attract foreign investors because nobody wants to hold a bond denominated in the Ghanaian kwacha or the Zambian kwacha. This creates a brutal vulnerability. When the dollar strengthens, which it tends to do precisely when global stress is high and people are fleeing for safety, everything gets worse for these countries at once. Their commodity export revenues fall in real terms as prices drop. Their import costs rise because a stronger dollar means their local currency buys less. Their debt servicing costs spike, and foreign investors, suddenly risk-averse, pull capital out, which weakens their currencies further, which makes all of the above even worse. It's a doom loop, and it activates almost automatically when dollar conditions tighten. Between 2021 and 2023, the U.S. Federal Reserve raised interest rates at the fastest pace in 40 years. It did this to fight inflation at home. It was a domestic policy, made for domestic reasons. But because the dollar is the world's reserve currency, it wasn't just a domestic consequence. As dollar interest rates rose, the dollar strengthened. Capital flowed back to the United States from emerging markets chasing higher yields. Currencies in Pakistan, Egypt, Sri Lanka, Ghana, and Argentina came under severe pressure. Several countries faced debt crises. Sri Lanka defaulted. Ghana restructured its debt. Pakistan came to the edge multiple times. The Fed wasn't trying to hurt those countries. It was just doing its job. That's almost the most unsettling part. The damage was a side effect, an externality, baked into the structure. Let's zoom out even further, because there's a longer story happening here that most financial coverage misses. The global dollar system is tightening structurally, not just cyclically, not just because of Fed rate hikes, but for deeper reasons that don't reverse when the Fed pivots. First, U.S. banks, especially after the 2008 financial crisis, became much more conservative at extending dollar credit internationally. Regulations like Basel III, Dodd-Frank, and various liquidity requirements made international dollar lending more expensive and more restricted. The private sector's appetite and capacity to manufacture synthetic dollars through the Eurodollar system shrank.